The United States Federal Reserve has once again raised the interest rate by 0.75%. This as the country's inflation levels touched a 40-year high. It's the second in a row and the fourth time this year that the Fed has raised interest rates. The Fed chair acknowledged the U.S. economy is slowing down and warned of a further hike in lending rates going forward, adding that it will continue to raise interest rates until inflation returns to its original 2% goal.
Today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 2.25% to 2.5%. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy.
The Fed's move will raise its key rate, which affects many consumer and business loans, in a range of 2.25% to 2.5%, its highest level since 2018. The Fed chief acknowledged that the economy has slowed down in some areas. However, the Fed also says that the country is currently not in a recession, as many parts of the economy were performing too well.
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. I do not think the U.S. is currently in a recession, and the reason is there are just too many areas of the economy that are performing, too well. And of course, I would point to the labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now.
Wall Street rallied after the Fed's announcement, cheering on the implication that the Fed may not have to raise rates so aggressively in the coming months. While the dollar retreated, but the fact remains that the surge in inflation has eroded consumer confidence. Consumers are showing signs of cutting spending in the face of a price rise, and business surveys project that sales are slowing with the November midterms approaching. The diminished approval ratings for President Joe Biden have increased the likelihood of Democrats losing control of the House and Senate. Well, WION's U.S. correspondent, Susan Tehrani, is joining us live from New York. Susan, this is the fourth interest rate hike this year. How's it impacting the average American?
Well, really, these interest hikes, what they've affected is a throttling housing market, suppressing stock prices, and also a low rise in layoffs, notably for small businesses like the ones behind me right now. And, the average American is paying something like 35% for a dozen of eggs compared to last year. What it hasn't done is bring down inflation. And this morning we found out that gross domestic product fell by 0.2%, the second quarter after 0.4% decline in the first. This is the technical definition of an inflation, despite the fact that the Biden administration, the definition of a recession, despite the fact that the Biden administration doesn't want to admit it and wants to not, redefine that definition. And for the average American, this is something that they're seeing in their day-to-day lives. They really are saying that they don't have the luxury of time, as Fed Chair Jerome Powell noted yesterday, saying that these interest rate hikes need time to bring down inflation.
Susan Tehrani reporting live from New York. Well, for more, we're being joined by Daniel Geltrude, a business analyst from Nutley, New Jersey. Daniel, thanks so much for joining us. First up, how much headroom do you think the Fed still has to go for further rate hikes? Is this the peak rate hike?
No, I don't think it's the peak rate hike, and I think that the Fed is leaving the door open that more rate hikes could be ahead. Jerome Powell made it very clear that they are going to continue to raise interest rates until it starts to impact inflation to the point where they hit their goal levels. And we're certainly not there yet. So unless there are some significant changes that occur with the U.S. economy related to inflation, I think we're going to continue to see this trend going the same way. Interest rates going up.
Daniel, markets think that yesterday's announcement was a pivot in some way. Do you think the same?
Actually, I don't. Look, there's a lot of word changing that goes on and double meanings and interpretation. I'm not going to get caught up with those details of body language and he selected this word or that word. I don't really think that matters as much as the overall statement that simply says inflation is not acceptable. We're going to continue to raise the interest rates, and we are already in a recession. I don't know if people are going to start changing the definition, but we are, as of today, in a recession in the United States. So what does that mean? Well, that means if you continue to raise interest rates to bring down inflation, you're talking about a deeper recession, and that is not a good thing.
Daniel, I mean, just as we stick with these rate hikes, I mean, will the future rate hikes, if any, could they be as high as 0.75%, or could it be even more?
Well, if you're going to start to get, going higher than 0.75, I mean, it starts to become fairly significant. However, that may be what the Fed thinks is necessary. So I really believe everything is on the table. But I want to say this. Remember, there is only so much the Fed can do, and that's basically to raise interest rates, to cool down demand. It is my opinion that we don't really have a demand problem. We have a supply problem. So I believe that we're actually approaching this inflation problem the wrong way. But that's the path that we seem to be on.
Daniel, thank you so much for your incisive expert analysis reporting live from New Jersey. Thanks for joining us.
Thank you.